Thank you. I don't think we can tell the bank regulators that it's not their fault because we had different monetary policies or fiscal policies over the last few years. I'm very old. Got some other old people here. We and some young people too, some much younger than myself. But us old people remember that we've had 0% interest rates, we've had 16% interest rates. Interest rates go up, interest rates go down. We've had fiscal budgetary surpluses under Clinton. We had enormous fiscal budgetary deficits under Trump and others. Fiscal policy goes up, fiscal policy goes down. We need a banking system where banks can survive, not only the existing fiscal and monetary policy, but changes as they may occur. Mr. Gould, you're wise to have pointed out the governance structure of the Fed and the whole system. First, we have forum shopping. We don't allow that in almost, you can't say, well, I don't like this IRS, I want to go to the other IRS to audit my returns. And we have a governance structure in which the banks elect the people on their regional boards, who are then in charge of auditing them. And if we had a system where only billionaires subject to audit would determine who is running the IRS, we'd have a very different tax system. Mr. Rashad, you bring up an interesting proposal on FDIC insurance. We kind of have two proposals. One is for expanding coverage of operating accounts. When you say operating account, are you limiting that to non-interest-bearing checking accounts?
Pretty much operating transaction accounts as defined.
But I mean, how would you define that?
Typically, I think it would be the operating accounts that businesses and nonprofits and others use for their daily business, and it could be.
It's very hard in running, determining. Well, am I a business? Am I just an individual? So the
FDIC in their report,
they have a definition.
They laid it out and gave you the bookends for what you could use for a definition.
Okay, I would think that we would want to limit that to non or pretty much low interest rate accounts. If people have more than $250,000 to invest or earn interest, that's a different circumstance. The other policy, though, idea is having, on occasion, temporary system-wide unlimited insurance. And I'm concerned that if we did that, people would pull their money out during that temporary period. Or we make it permanent and just have total FDIC insurance, which comes very close to a bailout. Is there, Mr. Machado and Mr. Gould, do you see unlimited insurance of all FDIC accounts, either temporary or permanent, as a way to go?
I've been a fan of the targeted approach, which is you can pick certain types of accounts, but not necessarily insuring all accounts.
I want to put up this this chart here. What we see here is this huge, unprecedented, unrealized losses on marketable securities. We saw our 2018 law allow the Fed to not be tough on these issues with regard to medium-sized banks. Ms. Judge or Mr. Gould, is it standard practice as a part of regulating a bank to calculate how much the bank has lost because of interest rate risk? You can do that obviously on marketable securities, but on portfolio loans, you say, that's a 5-year loan. At the time the loan was extended, rates were at 2% for 5-year loans. Now they're at 6% for 5-year loans. It's pretty easy to calculate back and determine how much the bank has lost. And then compare those losses, unrealized losses on loans and bonds, to the bank's capital. Is that a standard part of regulating banks?
Clearly it is for the largest banks.
But we could do it with all the banks, couldn't we?
And as a regulatory matter going forward, we should be clear.
So you're saying that just preparing a schedule showing losses due to interest rate risk is something we didn't bother to do on medium-sized banks, not because it's hard, but because we didn't want to know the answer.
I don't know what they were looking at the time. I believe, if I'm going to provide any defense, that there was an expectation that you would have some type of offset. The regional banks
Yeah,
pushed back against
what
this,
you do
arguing
is you
for
blind
gains.
yourself to how much money you've lost by believing your customers are willing to subsidize you by leaving the money in.
Which is
And if you believe that, you'd probably run up a $35 billion cost to our system.
Which is exactly why going forward, regardless of what was true in the past, going forward, depositors have woken up, and it's very clear we need to be more
gentleman's time
aggressive.
is expired.